Hello and welcome back to episode of 6 in Finance Maths Demystified. As a little reminder, what we've been through so far is everything leading up to today's episode on the efficient frontier. What's the efficient frontier? Well, it's going to be a tool that you can use to help you pick just the right portfolio to give you the maximum returns for the risk that you're comfortable with. So, if that sounds interesting, keep watching. Okay, so in the previous episodes, we looked at a number of different concepts, let's say, okay? We've looked at expected returns and the different kinds of expected returns. That's one side of the equation. And then on the other side, we looked at the relationship between standard deviation, volatility, covariance, and correlation. And then all of those concepts led into diversification, portfolio diversification. And now we get to mix the diversification aspect from covariance with expected returns and build something very interesting, the efficient frontier. So, what is the efficient frontier? Well, it's a concept from modern portfolio theory, and it's about allocating capital to your assets to maximize your return for a given level of risk. Now, modern portfolio theory was developed by Harry Markowitz. There's a couple of key assumptions that play into efficient frontier. Mainly, this is the assumption of efficient markets, so that the markets are perfectly efficient, right? And that all traders or investors in the market are rational. And that may seem a bit vague, but there is a particular definition for rational as well. Rational is described as it plays into two parts. A rational investor is one where if you give them an asset at some risk level and some volatility, so some volatility and some expected return, if you could offer them the same return for lower volatility, they would take it. They would always take the same return at a lower volatility. That's what a rational investor would do, okay? And if you could offer them a higher return for the same volatility, a rational investor would always take that deal. However, if you were to offer the rational investor an opportunity to have a lower return for the same volatility, they would say no. And if you could offer them a higher volatility for the same return, they would also say no. So that's the groundwork. However, if you could increase the volatility and increase the return at the same time, depending by what amounts, that may be equally favorable for a rational investor, okay? So a rational investor is interested in maximizing their return over reward. So to understand efficient frontier, we're going to have to take a step back and revisit what we covered in diversification. So when we looked at diversification, we were looking at how we could use the covariance matrix to help us pick the percentage allocations into different stocks of interest that minimized our exposure to unsystematic risk. Now, this process was pretty interesting in the sense that it gave us an insight that I didn't touch on during the previous episode, but I'll bring up here. When we optimize our portfolio in this way, when we optimize our allocations to minimize volatility, we end up with this interesting scenario where the resulting price action graph and the return that we get from it over a period of time actually displays a level of volatility, so our portfolio volatility, that is lower than the lowest volatility of any individual stock on this graph. Okay, so if we look here, you can see we have 22, 23, and our portfolio volatility is 20.20%. So the whole volatility of the portfolio is lower than the lowest individual asset or investment in our portfolio, okay? That's an important point. So this provides us one of the two dials that's going to be important for efficient frontier. The first dial is going to be for risk, and that's going to be using this right here, the diversification. The second dial I would like to add is for return. And if we can begin to control these two dials together, then we're beginning to get to a good position for understanding the efficient frontier. Okay then, so what exactly is the efficient frontier? What is this portfolio optimization technique, okay? Well, its objective is to find the optimal mix of assets in a portfolio that maximizes the return for a given risk. Or, yeah, as I've written here, minimizes risk for a given return. You can do it both ways, okay? So, imagine here that you've got a selection of stocks, stock A, B, C, D, doesn't matter, okay? This process is going to take these stocks, it's going to analyze historic data about these stocks, and then it's going to generate the returns, the expected returns of these stocks, and then the volatility of these stocks, or really it's the risk. It's just usually we use volatility, and that's what's used in MPT, okay, modern portfolio theory. And then once we have these, we're going to run an algorithm, and this algorithm then is going to spit out a selection of percentages, and this will be the allocations that we would take in each asset to achieve a certain risk reward value that we have desired. And ideally, as we're rational investors, if we've specified a particular risk reward point that we'd like to hit, if it can, it will provide us more reward at lower risk also. And this will be the optimum portfolio allocation spit out here. So what does it actually look like? Well, and how do you go about plotting it? First of all, how does it look like? You've got to plot it. How would you plot it? There's a couple of different ways to do this. You can use what's called a stochastic simulation. You can use linear algebra, and you can use optimization, okay? And regardless of which one you're going to use, this is a pretty good visualization of the efficient frontier. This image has been generated using a stochastic simulation, or to be specific, a mixture of stochastic and optimization, or really it's a mixture of all three of these, okay? So this minimum volatility portfolio here, this red star, is the one that's the most bottom left, here. And that minimum volatility portfolio is exactly this one here that we looked at in the diversification episode, okay? That's this one. There's another portfolio that's of particular interest to us, and that is the maximum Sharpe ratio portfolio. Now, we don't know what the Sharpe ratio is just yet. You might, but we've not covered it in the series. But basically think of this as the most efficient portfolio. This is the portfolio that maximizes your risk for return overall. Of all of the portfolios here, this one is the one that has the best risk return trade-off, okay? And then the rest of them you can see kind of follow this line here. And then some portfolios exist below and to the right of this line, but nothing exists above or to the left of it. And this boundary between this string of portfolios and this darkness on the other side, this line is what is actually referred to as the efficient frontier. And any rational investor, okay, this is the important part of assuming that traders and investors in the market are rational. Any rational investor would only ever pick a portfolio that lies on the boundary. You would never, for example, pick this portfolio when you could pick this portfolio, or pick this one when you could pick this one, okay? For every point on this graph, you want to optimize so that you are either increasing your return for the same volatility, traveling up, or decreasing your volatility for the same level of return, traveling across, okay? But you'd never want to go into the massive portfolios here, reducing return and increasing volatility. So each of these dots now would be, imagine if you could click on this dot. If I clicked on this one here, if I've done this efficient frontier with, say, the Magnificent 7 stocks, right? If I clicked on this here, this would give me a percentage allocation for each of them. So I click this dot and it would say 10% Meta, 13% Netflix, 20% Amazon, whatever percent Google, blah, 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 you get the point. So each of these dots is a different combination of allocations into the same assets. And then those portfolios are what is being ranked on this graph here, okay? So in terms of building the efficient frontier, How do you go about it? Well, step one is data collection. Given the previous episodes, you need to get the historic returns and we'll calculate the expected returns, okay? Ideally, the geometric return, okay? Particularly if you want to do forecasting based off of the result that you get from this analysis. So, historic returns. And then you're going to calculate the covariance matrix as well, okay? As we showed in the previous episode. Once you've calculated the covariance matrix and the expected returns, now you can use an optimization algorithm. You can do a quadratic optimization of the formula that was shown in covariance and volatility, the W sigma W transpose, which is your portfolio volatility given some weights in a covariance matrix. You can minimize that, right? You can minimize that value and get the allocations out there. That would be your minimum volatility portfolio right here, okay? And then you could work out your maximum volatility portfolio using a similar method, the inverse, and then you could find all the linear combinations of those portfolios to plot out this frontier. If you don't want to get that in depth with the maths and the linear algebra, what you could do is just randomly generate a whole bunch of different potential portfolios, different weights, right? And then calculate after the matter using that W transpose sigma W formula, what the volatility is and the expected return of the portfolio. And then for each of the random set of weights that you've generated, you would plot them like this, and then you would just loop through them and work out which one would be the most efficient, and then you could find your efficient portfolio that way. So these are the practical steps that you would take. And then how to actually use this in the real world? Well, you take a bunch of the stocks that you're interested in or assets that you're interested in, you give them to this formula, and you should get out some sort of allocation, right, that is efficient based on historic data. And that's important, based on historic data, right? What this means is these assumptions that all traders are rational, it's not always the case. There are plenty of traders, particularly on the retail area, that would rather take the same level of return for much higher volatility as a ratio, right? This is where you see people getting on stock mania. A recent example of this might be something like SMCI, for example, a stock that's rallied 1000%, I think, in the last year and a half, 2 years. And very often, hype and media outlet will influence the trading decisions of individuals rather than pure rationale, okay? So not all traders are what we would describe as rational, number one. And we know that historic performance in the past doesn't always predict future success, okay? And that might seem obvious, but it really is true. You might have a stock like that that's been rallying for a long period of time. The theoretical expected return is massive, but there's a whole bunch of indicators that are showing that this stock might experience a downturn or it's massively overvalued. Efficient Frontier doesn't take into concept this idea of stocks being overvalued or mania, etc. It's purely just looking at the historic returns, volatility, and turning it into a mathematical optimization problem. So those really are the limitations here. But as a tool in your arsenal, it's absolutely something you want to use to try and understand, given a set of stocks, what should you be investing in each. And there are a couple of fun facts from this, right? This Sharpe ratio here, right? If you had the computational power to do an efficient frontier on all of the assets in the market, right, this would effectively be a market index, right? When you have QQQ or SPY and you have these ETFs that are tracking the market, they're effectively taking a huge subsection of the market and finding out what this maximum Sharpe ratio portfolio is for that subsection. You can't really do it for the entire market, but when you have things like the NASDAQ or the Dow Jones and you're looking at just technology stocks mostly, or industry or energy or whatever ETF, right? This is what they're doing. They're taking a big portion of the market and they're trying to work out, what would be a efficient allocation of all of these assets? And if we've got that, then assuming efficient markets and rational investing, we should have something that closely tracks the market performance, okay? So that is one of the outcomes of this work. So Hopefully now you understand what the efficient frontier is, how it connects with expected returns and covariance. If you want to go and dive more into the maths and the optimization of how to do this, there's plenty of resources online, but this is absolutely a tool that you should have in your kit if you are investing. And you don't have to tie yourself into a specific time frame here, right? You could get the annualized expected returns and annualized covariance matrix. That's why I went into detail on the previous lessons about how to do that, right? But you could also do a monthly forecast or a weekly forecast, or every 2 years, or a quarterly forecast, etc. Really, whatever you want. Once you understand the mechanism behind it, you can really use this in any process that fits your needs. All right. Thanks for watching. Stick around for the next episode on Finance Maths Demystified. Cheers.